morning, and thank you everyone for joining us for the Q1 earnings call. I'm joined, as Gavin has already highlighted, by Zarir, my colleague and Executive Director on the board, John Mulal, our CFO, and they will walk through some of the details as we move forward. I'd like to start with highlighting a couple of issues, a couple of points before I get into details of several of the elements as they've played out during the course of the current quarter. As you know, we have four verticals in this company. First is performance materials, and the performance materials vertical has basically is comprising of soda ash and sodium bicarbonate as the key product. It also has a very small emerging business in terms of silica business. The second vertical we have is nutrition science. The nutrition science business has the iodized salt, which we sell to Tata Consumer, which we demerged in the last quarter last year. And we have the FOS and GOS, the oligosaccharides, the probiotics and prebiotics products which we are selling to other food companies. And there are many more products to come in this space. The third vertical is agri-science, which we do through Rallis. And that piece of the business is run through our subsidiary, a 51% subsidiary with Tata Chemicals. The last business which we have is energy science, which is a nascent business, yet to be seeded fully, still figuring out with customers what they need to do. In terms of the overall performance, let me start with the performance material business. The soda ash business was, as you know, has exposure to various sectors. And the performance has been in line with the way the sectors have performed during this lockdown period and the extreme turbulence around the world. And the sectors like detergents, the sectors like personal care, the sectors like other chemicals have done well. Whereas the sector like flat glass, which goes mainly into automotive and real estate, those consuming sectors within soda ash have had difficult quarter as far as we are concerned, but these are behind us, and these factories are opening slowly, and we hope as time passes by, the softness would start to reduce, and the demand would start to pick up coming from these sectors. Overall, if you look at the performance of this, while UK and Kenya have very limited exposure to flat glass, and hence their numbers have been more or less steady and have run to the plan. There were some disturbances with respect to logistics because of port closures. Beyond that, I think there is no customer demand issue because, as you know, the bulk of the sales of Magadi goes to container glass, and bulk of the sales in UK, again, they have almost zero exposure to flat glass. The flat glass exposure is in India and US. In India, it's fairly limited. To that extent, Indian demand was okay. In US, the exposure is slightly more, and especially the exposure to the exports is almost 50% to flat glass, and that tended to feel the pressure of the activity. I hope as countries reopen, as the pressure of the pandemic reduces, these markets will open and will come back on stream, and Zarir will add more color to that. As far as our HDS is concerned, the silica business in performance material, they resumed operations around the middle of May. And since then, they've had a very good traction in terms of demand and would continue to do well. We are also happy to say that the Tamil Nadu government has actually allocated additional land to us for expansion and growth of this business, and we will continue to build this business going forward. In terms of the nutrition science, the salt did very well because of consumer demand. I think there was a stocking by everyone because of the fears of shutdown. And bicarbonate also did very well, the food grade and the pharma grade. And the nutraceuticals also performed well post reopening the number 2 plant, which again reopened somewhere around middle of May. In fact, both these new plants have done better than previous year in terms of turnover despite the lockdown. British Salt in UK, again a salt part of the segment, has done well, and the bicarbonate food grade and pharma grade bicarb in UK has done well during this period and continue to post strong sales. In agri-science, our unit Rallis has done commendable work in terms of the sales as well as the operations, despite difficulties in terms of running those operations, which we have faced across the board with respect to labor and workforce mobilization, workforce safety, which were our primary concerns, and continue to perform well. And we hope that with good monsoon, that would continue to move forward. With respect to energy science, I think our prioritization has been to calibrate our capital spend in this business, which is a new business, in sync with our customers. And as you know, that the auto sector is under serious pressure, we are watching and waiting. We are not in a rush to sort of spend money. And at the same time, we are also continuing our efforts to develop products which are in the next generation, which is beyond lithium. That work continues. As far as lithium battery cell is concerned, we have tapered down our investment plan in sync with our customers' situation in the auto sector. So to conclude, our focus during this period has been to produce as per demand, which means we've been having a tight control on inventory except to raw materials where it has been secured for strategic reasons. We have continued to make sure that we collect from our customers well in time so that our overdues are kept in check, and we continue to focus on cash, run all the units for cash, and happy to say that has been delivered by the team. We've also calibrated our fixed cost build-up, and we've also conserved wherever the customer demand is going to be slightly slower to pick up. We have postponed those capex and accelerated the capex where we know the demand is going to be high, especially in the nutrition as well as in the agri segment. As I want to conclude, I just wanted to say that our long-term strategy is intact. We will be continuing our focus to move the performance material business towards more value-added products, even as we debottleneck some of the areas. So while we will debottleneck our Mithapur plant, and those plans are afoot in the soda ash area, our investments will continue to expand the value-added product segment, both in terms of bicarbonate, which is a value-added product of soda ash, as well as investments in various other solutions we give to customers in terms of speckles for detergent business. In terms of nutrition science, we will continue to focus on our investment plan, our growth plan in terms of expanding from 1 million ton to 1.5 million ton of salt is on track, and despite the issues with respect to project execution, we don't anticipate delays. In fact, our agri-science, again, I think we are focused completely on executing our expansion plan to support both domestic and international market. On energy science, as I said, we have tapered down our ambition, but at the same time, this remains one of the pillars we'll continue to focus. So all in all, I would say the company is well positioned through these 4 verticals to deliver to market: performance materials, nutrition science, agri-science, and energy science. And we are very confident of navigating through this difficult time in terms of this pandemic, and we are very confident as we emerge out of this sometime around the first quarter of next calendar year, we would be in a much, much better shape as a company which is re-engineered itself and is reprogrammed itself to serve its customers well. With that, I'll hand this over to John to explain the financial numbers, and then we will open this up for Q&A. Thank you.
Thanks, Mokund, and good morning, everyone. Now, I expect there's going to be a lot of interest in the company's view of the coming quarters, but before that, I'd just like to add some colour to the financial results for the quarter, which we published on Friday night. While the profit before tax and standalone results was down 149 crores, of this, around 120 crores actually related to reduction in other income at line 1B. Within there, you have a timing of a dividend receipt. We didn't receive any dividends from a massive or RAS this quarter. We got 98 crores last year. The massive dividend last year of 72 crores, including a one-off element that we did to reduce the cash build-up in Morocco. And this year, when we get it in quarter 2, I expect it to be around 25 crores. We also, the RAL's dividend of 26 crores, we will not get until quarter two. And we also had reduced bank interest, mutual fund and fixed deposit income of about down 32 crores compared to last year. This is really a result of a slightly reduced cash balance, but also the reduced rates we're seeing in the marketplace today. And that's also the reason why you'll see a reduction in the unallocated income in the segment analysis of the SEBI sheet on page 2. From the operations side, while revenue is down around 91 crores, the gross margin itself actually held up quite well. This is in TCL standalone. The gross margin came in about 62.6% against 63.1% last year, so 0.5% reduction compared to last year. The revenue reduction itself was seen most in soda ash and sodium bicarbonate volumes, but this is offset by a strong salt performance. Prices did come under pressure, but mix and some variable cost savings did limit the non-salt adverse price mix variance to around 10 crores to last quarter last year. Our finance costs in India were down 15 crores on last year, really reflecting the payment of the ECB loan in October and the NCDs in July 2019. Our India cash position, as cash, mutual fund deposits and bank deposits, moved to 1,999 crores in June compared to 2,162 crores in March, a reduction of 163 crores. Capital spending in the quarter in India was 105 crores against 175 crores last year. Looking at international operations, and as Mokan mentioned, that the steepest decline we saw was in North America. Sales volumes were 152,000 metric tons below last year, and nearly all of this was export related, and this no doubt will be this discussions later on in the Q&A. Profit before tax in the US operation was reduced by 210 crores from last year. 2/3 of that is actually volume related. 140 crores is volume related. Adverse price impact of export sales is around 30 crores. And while good fixed cost savings were actually offset by a deliberate reduction in mine output and surface production output to control cost and also to limit inventory build-up. We did complete the $375 million refinance in North America in some quite challenging market conditions, and we had some additional costs as we changed the financing structure. The new arrangements will still be cheaper this year compared to the anticipated costs of the previously contemplated finance facility. For Magadi, they did record a marginal loss before tax of 2 crores. And while sales were down 6,000 tons at 62,000 tons in the quarter, due to the larger impact we've seen in pricing and destination mix, these adverse results were partially offset by some rail and fixed cost compression. The underlying UK performance itself was actually better than last year. We had a 12 crore exceptional gain last year, and this year it was actually 3 crores. For Tata Chemicals Europe, although the soda ash sales were down 6,000 tons, 4,300 tons of that was actually PFR sales last year, which had minimal margin. So this mix improvement, along with lower input costs really on coke and better manufacturing efficiency, alongside good bicarbonate sales, produced better contribution margins for both business units, the soda ash and sodium bicarbonate business unit. UK salt operations were impacted slightly by sales mix as a result of the pandemic restrictions, but lower input costs, mainly gas, did contribute to slightly better performance than last year. And overall, our consolidated cash finished the quarter at 3,258 crores, and net debt was 3,760 crores. And with that, I'll hand back to Gavin, and then we'll open the lines up for questions.
So can we open the call for a Q&A session now?
Yeah, please do.
Thank you very much. Ladies and gentlemen, we will now begin the question-answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We take the first question from the line of Madhav Mehta from Fidelity Investment. Please go ahead.
Yeah, hi sir. Good morning and thank you so much for your time. My question was specifically on the US operations. So our EBITDA per ton in this market has been about $45 to $50 for the longest time, and obviously this quarter, because of the lower volumes, it has been impacted. But I'm just trying to reconcile why the EBITDA per ton has come down to about $12-13 per ton versus $45. What's been the reason for the decline? I mean, is it like product mix or operating leverage? What's impacted us here?
Yeah, well, like I said, a relatively high fixed cost base in North America has a disproportionate impact when you reduce the volume. And the price reduction on our export sales as well. So two things. One, significant volume reduction, which does impact your overhead recovery rates. The second piece is the price reduction. The third one is we took the mine and we curtailed production to meet demand, so we weren't building up stock and wasting cash that way, which is that's really what's driven the reduction in EBITDA per ton.
Okay. If I'm not sure if I'm doing it right, but if I look at your ASP per ton, which is just dividing the revenues by the volumes, ASP seems flat or a little higher actually. YOY. I'm not sure what am I missing here.
Yeah, no, the price is down, I guess, last year.
Okay. All right. Okay. I'll just recheck maybe. And maybe one other question. How soon do we think the US operations, the volumes come back to more normalized levels? How many quarters do you think your anticipation is it could take?
So I think let me come in here and maybe Zarir can add more color to this. Broadly speaking, if you look at the US operation, I think the market mix will keep changing the realization because the domestic market realizations are higher than the international market. As international markets go down, the volume goes down, the pricing mix will keep changing. But broadly, I think their contribution margin has been in line with what we usually do. And if I take a broad range, I mean, contribution margin should hover around about 55% broadly. So if you look at the compression which the sales have gone, I think that would broadly explain the compression in the at the EBITDA level. And if at all, it will also tell you that there is a bit of a gain which has come in because of certain fixed cost effort the team has put in place. That's really the way I would sort of look at it, because we can look at the loss of revenue itself and you look at the loss of contribution arising out of that revenue at 55%, it's about 125 odd crores broadly. On a EBITDA of 189, that 125 crore compression should have led to EBITDA which should be close to about 60-70. I think the fixed cost absorption, as John has highlighted, has led to a bit of a pressure on the EBITDA, a little bit more than what one would normally anticipate. So at the contribution margin level, we don't see any big difference. It is basically the volume pickup which will address most of the issues there. As far as the PBT level is concerned, from EBITDA to PBT when you go, there is a $5 million additional cost which has happened this quarter, which will not repeat, which John has highlighted, because that was a part of the refinancing net out, takeout cost, because we wanted to move to a different structure. And that structure actually is a cheaper finance than the current arrangement. So overall, the company benefits, but we had to take the entire takeout cost this quarter itself rather than amortize because of the accounting standards. So that explains away at the PBT level about 35 odd crores of cost. That's approximately $5 million. John, am I right about that?
Yeah, just under 4, yeah. So that's close enough.
Yeah. So I think the real issue is which you raised as a question, when would the volumes come back? That question has to be answered fundamentally. The domestic market, really, the slowdown in the domestic market was in US was not as severe. In fact, the Indian domestic market was more severe in terms of slowdown than the US market. The real issue for US is the export market. When will they come back? And our own understanding is it is going to start trending up slowly. Quarter 2 would see slightly better than quarter 1. but quarter 3 would see it more. But when would it return back to normal? I think maybe by the last quarter of this year or the first quarter of the next calendar year is when we believe the thing would get to bit of a normal. If you look at two of their export markets, the large export markets are Southeast Asia and South America. South America is especially going through a real difficult time in terms of pandemic, and Southeast Asia hopefully will recover earlier than South America. We expect South America also to swing back closer to the last quarter of this calendar year, which is somewhere around Jan, March, or around that time.
Okay. And maybe just one follow-up from my side. On the pricing side, in our key markets in US and India, can we see more pricing pressure going ahead, given capacity utilizations are a bit lower in the global soda ash market, or it could be more resilient?
See, in the quarter 1, in my view, the pricing pressure was there, but I think the pricing pressure did not translate into what I would call margin pressure, because the input costs also came down in terms of energy costs. Only one place where the input cost did not come down was Magadi, because they had certain oil hedges in place, and those hedges meant that they could not get the benefit of the lower oil price during the first quarter, which they will get in the second quarter. So clearly, the rest of the units will get certain benefit coming in because of the low energy costs, which protected them in the first quarter. Going into second quarter, I think even if there is a pricing pressure, our assessment of the pricing issues, especially in Southeast Asia, they probably are reaching the bottom. Zarir, you may want to add exactly what is your understanding of whether they are at bottom or maybe another $1 or $2 down.
Sure. So just once again, just going back to pricing for our North American unit, once again, it would be useful to break it down into domestic and export. Domestic is primarily contracted, and we are seeing customers honoring their contracts. So the pressure on pricing in North America, at least till the end of the year, is likely to be minimal. In the export markets, as Mukund mentioned, yes, there has been some contraction in pricing. Our view is that in Southeast Asia, this has possibly reached the bottom as far as Chinese pricing into that market is concerned. Most of the Chinese producers today, we believe, are trying to move pricing up, given the fact that their margins and their cash contributions are really at rock bottom today. We might see a little more aggression from the Turkish player in that market. The market today is at a level of about $185 to $200 CFR. At best, we believe it might slip down another few dollars to maybe 180, 181. But I think that should be the bottom of the market, and certainly not with all customers, with selected spot offers into that market. But that being said, yes, the export markets will continue to be under a bit of stress, at least till the first quarter of next year, or the last quarter of our financial year.
Yeah, and to further add to what Zarir has said, I think you need to watch out for a few sectors in this. I think watch out for how the sectoral demand, especially the auto sector around the world, gets back in shape. As it bounces back, as that, especially the passenger vehicle demand comes back, whether it is in small or large vehicle, it really does not matter. For us, the small vehicles are much better because you sell more glass per dollar value of the car. I think the market demand direction will be outlined by that very specific segment. The issue is fundamentally going to be driven by that, and that will be driven by how well the pandemic has been controlled. So our view still is that Southeast Asia, it has been controlled better. South America is still not clear. I think they are under deeper pressure now. They will probably take another 4 to 6 months to get it underway, which is why we are saying by the fourth quarter of this year, they could see better turn of light. This is under the assumption that India continues to do a good job. If we take the turn for worse, I think we are going for a bit of a root shock.
All right. Thank you so much for the detailed response, sir. Thank you.
Thank you, Madhav.
Thank you. We take the next question from the line of Abhijit Akella from IIFL. Please go ahead.
Yes, thank you so much. Just a couple of questions from my side. One is just a follow-up on the North American market. How much of the decline in volume is, or in 1Q, was because of logistics and by, plant closures, just because of operational or other lockdown issues in the export markets for North America, versus how much of it was because of just weakness in end user demand? And, therefore, what kind of recovery could we possibly expect in 2Q? And then a corollary to that, just on the EBITDA per ton, what would be I know that this quarter there was some, unabsorbed fixed cost, but what would be a more normalized kind of number looking ahead from 2Q onwards?
So in terms of the U.S. exports, there were no port closures in U.S. itself. And if you really look at where there are port closures in Southeast Asia, there were some, but I think they are not the main driver of this. So I would just simply say that as far as the U.S. market movement is concerned, it is primarily driven by the demand at the customer end. This is not related to any port-related issues. The port-related issues mostly were concentrated in even one of our units, which is in Kenya, where Mombasa had some issues when they were trying to export, but that is also behind them. So really, these were not operational hiccups at all. Bulk of it, and I would say 90-95% of this is just the sheer demand not being there. Zarir, you want to add?
No, absolutely correct. I think port closures in some markets in Southeast Asia may be in the first half of April, but insignificant. I think most of the ports are now opened up. It's really pipeline stocks and lack of demand from end users. And primarily in the export market, that translates into lack of demand from float glass producers. The others are slowly coming back in line, but the path to recovery for the float manufacturers in the key export markets is likely to take longer. We are seeing very encouraging signs out of China in terms of both vehicle and infrastructure demand, and maybe we'll see some spillover of that into the Southeast Asian markets as well. But it is a wait and watch situation. Q2, as Mukund mentioned, will be marginally better than Q1. Q3 might see a further uptick, but really to see any significant movement, we might have to wait till Q4.
Yeah, and I think just to add a color, I think if you look at the segments as container glass, flat glass, and detergents and other chemicals, if you put it there, detergents, the chemicals, I think we continue to see steady demand. As far as container glass is concerned, there was a bit of a dip and then it picked up. In fact, it moved up beyond the current year in most markets except India. And I'll come to India, why India behaved differently. Around the world, the in-house consumption of beer and liquor actually increased, which meant that people were buying more bottles. The demand for bottles did go up. Whereas in India, I think the entire liquor consumption had been shut down, so that sector suffered only in India, container glass sector. Container glass also feeds into pharmaceutical glass. I think that those sectors are seeing good demand strength. So that leaves us with flat glass, and flat glass fundamentally is driven off in large numbers by auto sector in Southeast Asia, and in Latin America, it is driven off the housing starts and housing constructions. And as far as our understanding is concerned, this is going to be clearly a direction which we need to get from our customers. Auto sector customers believe that personal transportation will receive a boost, but that is only an expectation. We don't know for real. So as the float glass demand comes back, you could then start to predict the soda ash demand. The good news is there is Southeast Asia and South America don't have any domestic production of soda ash. It's all international suppliers who are there. And if the demand comes back, everybody will have room to play. If the demand is slow to come back beyond, let us say, fourth quarter of this year, then I think we need to then say, look at what are the avenues to shift the marketing place. So I think this is a medium, let's say, short-term issue which we are concerned with. As far as the medium term is concerned, the Tata Chemicals is already, we are, in terms of exposure to flat glass sector, our exposure is less than the industry. In India, it is less than the industry. Internationally also, it is less than the industry. In fact, in UK and in Kenya, we are not exposed to flat glass. And what we are trying to do, both in India, especially in India in the short term, is to also switch our production and product mix away from the sectors which are vulnerable. In US, it will take a bit longer time, but there again, the plans are afoot to sort of make sure that market mix switch changes over a period of time. So our medium-term attempt is going to be fundamentally switch the product mix to more resilient sectors and continue to focus on them. There's hardly any realization difference between all the sectors. So it really who is serving which sector, and that creates an impact on the P&L and bottom line.
Thank you. That's really helpful. And then my second question was just with regard to the capex plans for this year. You've talked about dialing down your investments in sectors that are, not seeing very clear demand going forward. So on a consolidated basis, what kind of capex should we expect for fiscal 21? And then, in case it yields any surplus cash, would you prefer to use that cash to pay down debt, or, are there any other plans in mind? Thank you so much.
So in terms of clearly, if you look at the one which we have dialed down even as we speak, and I think it's part of the strategy, is the storage battery business, because we think the demand, we will see demand robustness not from the mobility solution in the short term, at least when I say 12 to 18 to 24 months, because the vehicle companies will be under serious stress in terms of putting out new what I call new vehicles in the market, because they will tend to depend on what is already on the drawing board, not to do something new. And I think the government support in terms of electrification also will be under pressure, because there will be financial pressures in terms of giving fiscal benefits for boosting the domestic EV shift in the short term. In the long term, that still is a vertical which we must play in. Also in the short term, I think the solutions will for energy science will switch to stationary solutions. And for that, we don't need to actually invest in a factory. There is enough surplus capacity around the world. We can assemble and give solutions to our customers. So we are engaging with customers, but that necessarily need not mean a factory build out, because there are solutions available which are available from the current manufacturers around the world, which we can assemble and ship to our any orders which we may win. So we have dialed down completely the energy science business. That is a fact, which I also highlighted in my opening remarks. As far as the agro science is concerned, there is no change in our plan. In fact, we are accelerating some of the startups. We are taking additional capital spend there to push the production of both our formulation and our technical products. And this is happening in Dahej as well as in Ankleshwar. Both plants are being pushed up to give the solution. Also, if you look at our nutraceutical and our silica plant, I mentioned as far as the nutraceutical is concerned, our factory can expand 4 times the current size, and we are seeing a very good customer demand. So we hope to come back and continue to report strong numbers there. And hopefully by the year end, we'll have you would see the growth in that sector happening. As far as the silica is concerned, our solutions to tire industry was constrained by the current capacity and also the land which was available for expansion, which Tamil Nadu government has allotted additional land to us only, I think, last month, even during the pandemic. So we are going to go ahead with investing in that. As far as the salt is concerned in Mithapur itself, as well as in UK, the investment shift to bicarb and salt in UK continues as planned. As far as India is concerned, the expansion of salt from 1 million to 1.5 million ton, in fact, is getting accelerated. There is a slowing down in terms of some of the investments we were making, especially in terms of the capital spends in US as well as in India, especially with respect to some of the commoditized chemicals. But that slowdown also is not very dramatic to write about, but it's just extension of the phase. So I think in terms of capex spend, it is not going to be such a sharp dip, but it's going to be a slight dip. John, you want to add some number to this? At least in the first quarter, you've seen a dip. I think that shift will continue even during the next couple of quarters. The big issue, let me just highlight, is not coming from our intent to grow. It is actually coming from constraints in terms of project execution. We are not able to get the equipments on time. We are not able to get the workforce on time, which is leading to delay, which is leading to prioritization of what we put up. So in the order of priority, anything which goes to nutrition and agriculture sector will get faster attention from us. The rest of the sectors will be deprioritized. And the constraint is not cash. The constraint is not the strategic intent, because our strategy is very well crafted in terms of delivery to market. But our issue is more coming from the workforce and availability of project teams to execute these. So that's why the prioritization is happening. So we could see a shortfall by 150 to 100 odd crores from our normal spend, but I don't see a dramatic dip below that. John, over to you.
Thanks, Mukund. Yeah, I'd agree with that. But probably it could end up being about between 5 and 10% down on last year's spending. But what you just have to watch out for, where we have some important strategic investments, like in Rallis, where they're doing some development expansion work, or in the UK, where we're building out the carbon capture use facility and spending some more money on developing backup facility. We will continue spending money in these areas because these are margin accretive strategic investments. But where the return could potentially be uncertain, or we're just not sure what's going to happen in the next 1 or 2 years, then we'll dial back. At this stage today, I would probably say we're between 5 and 10% down on last year. But that might change a little bit.
Yeah. Also, when your question about debt reduction, I think allow us time till the second quarter to come back to you. There is definitely work going on, and I think we do think it's one of the things we must do going forward. So we will get that also as a plan and present back to you. Right now, I don't want to comment while the work is going to review exactly how we need to move in that direction. But we are clearly focused to take even the international debt out, so that we become as prudent in terms of debt overhang in the company, even internationally. Even though domestic business is in good shape, we are also trying to move that also out in the same direction.
Great. Thank you. Thank you so much, and wish you all the best.
Thank you. We take the next question from the line of Tarang Agarwal from Old Bridge Capital. Please go ahead.
Hello, sir. Good afternoon. My question is with respect to your international soda ash business. In a medium-term basis, what is the return on capital employed that the management envisages to achieve on its international soda ash ops, that is US, UK, and Magadi? One. And the second is, what are the levers in the current business to move it to those levels?
I think if you look at ROC typical calculations, I think it's in terms of UK and Magadi, it really has, the capital there broadly. If you look at the books, it's hardly minor capital. It's been mostly written down. So any profits we make there is going to yield good returns. It will be in upwards of 12 to 15% return. I think John can share the more accurate figures with you. As far as the US is concerned, there the return on capital employed in the dollar terms is between 6 to 7% broadly. And I think as we move the product mix to value-added products, we want to take it at least to certain decent double-digit figures. I think that's the plan. Right now, we don't want to make any comment on exactly where we land the U.S. business with the value-added product move which we want to make. So we will come back to you with specifics as and when those plans are clear. But clearly, our approach to U.S. is to move that entire business to more value-added products.
Okay. Thank you.
Thank you. We take the next question from the line of Sumant Kumar from Motilal Oswal. Please go ahead.
Yeah, hi sir. My question is regarding US business. So we have seen the trend of quarterly total expenditure of 650 to 700 crore. So can you quantify what is the fixed and variable mix of total the run rate of 650 to 700 crore per quarter?
So what's the 650 to 700 crores?
So when we see the total expenditure quarterly for Tata Chemicals US business, so you give EBITDA. So when we subtract sales minus EBITDA, that is the total expenditure. So run rate, what we have seen 650 to 700 crore per quarter. So can you tell us what is the mix of fixed and variable cost for the total expenditure annually or quarterly for the Tata Chemicals US business?
Quarterly, no, we won't give that out. But what I said in my at the start is that it's a fairly high fixed cost business. It's for very simple reasons. It's an extractive process where we basically buy the rights to mine the area, and then there's no real input cost other than gas and coal. Yeah. So the rest of the cost is going to be fairly fixed. So the labour, if you like, depreciation, some of the production consumables, maintenance expenditure, that sort of thing, that's generally all going to be fixed. If I had to put it down, I'd probably say a third's variable, but that could change.
Any broader range of fixed and variable cost mix in broader range?
No, I mean, you'll see some more information there through our statutory account social file on the website.
Okay.
But what is he trying to get to? We've talked. Send me an email offline. And I'll see
John, let me intervene. I think I'd already indicated when the first question came that if you broadly it should be around 55% contribution business. Broadly, give or take 1% here or there. I think the reason I'm saying broadly is the quarter one, any pressure on price was taken out by the reduction in the energy costs and other costs, variable costs, which held that percentage up. So if you take 55% broadly, I think that would give you an indicator of what the contribution number is. Then post that is all fixed. So that should help you with between EBITDA and contribution. You would find more or less it's either semi-variable or fixed. So we can't add color beyond this because quarter on quarter this 55 may move because of product mix. If there's a higher export business, then this may shrink. If there's a higher domestic percentage, this may increase. And it also moves broadly in sync with the issues related to how the energy prices and gas prices move. So, but I think if you want a thumb rule, I think that should give you a good fix in terms of the US number.
And you said the contribution margin for US is same compared to previous year. So then why gross margin has declined in Q1 FY21 at console level? Which subsidiaries granted gross margin?
I think broadly that the margin levels in US we have given you on the slide 15. If you go to slide 15, which we have shared with you.
Okay.
Please work off that, and in terms of the other ones, we can get specific about each item, and John has already highlighted the margin levels in India have been stable. I don't think any place has had a margin issues in terms of contribution margin. The issue fundamentally is that more or less every one of these units has held well as far as the contribution margin is concerned. John, has there been any sharp erosion in any of the other units? Because I did not see that. It's basically volume effect, right?
That's right. It's volume mix effect. So that the higher contribution level in North America and their sharp reductions going to have a higher level on the consolidated basis. But there's no. We talked about the reduction in India and North America, and that's kind of it.
Is it all because of Rallis India gross margin contraction at console level? No, no.
Sorry?
What we're saying here is that.
Yeah, I'm talking about the console level gross margin decline is because of Rallis India. If other subsidiaries has done well at gross margin level.
I don't know. We have certainly shared with you on slide 15 entity level numbers, and I've also highlighted to you the gross margin in US. I think this should give you a very clear picture.
Okay. And
seconds.
Okay. Yeah. Talking about...
No, you're missing the disproportionate size of the US operation, and its reduction has a bigger impact on the consolidated gross margin. Okay? If I look at the gross margins across the piece, each of the entities, they're down slightly. In the UK, it's up a little bit, but they're down. But the bigger element is the size of the US operation and its reduction on the consolidated piece. Yeah? That's a mixed element of the US compared to the rest of the businesses.
Okay. And talking about the export and domestic mix, what we have seen in Q1 21, it is export is 45% of total business. So I think annual level it is lower, right?
I didn't get your question. What was it?
The export and domestic mix of US business in Q1 FY20 as per the PPT is 55-45, right? So at annual level it is, I think, far lower. The mix. The export is lower.
Export being the 45.
Ravi, you want to address?
No, it's about the same actually. If you add it up.
Okay.
Export volumes hover between 45-48% for North America.
Annual basis.
That's right.
Okay. Yeah, thank you.
Thank you. We take the next question from the line of Girish Pathak from Goldman Sachs. Please go ahead.
Yeah, thank you for taking the question. Just one basic understanding. The standalone segmental data where you mentioned the specialty products revenue, the underlying business in that is nutraceuticals and the silica business, or that is part of Concall and this. Can you just help me understand what is the underlying business in the standalone specialty products of 15.89 crore for the quarter?
Yeah, I think that this is a bit of so the underlying specialty is basically the FOS, the nutraceutical and the silica business. And clearly, I think the segments are not the way I explained it. I think we will move to that the way the businesses are structured.
Okay. So in the standalone segment assets, I see specialty at 578 crores. That probably represents the capex that you did in the silica and the nutraceutical business, right? That 600 crores, 300 crores each.
It would also include about 75 odd crores we've invested in land and energy science and buying land. It is not been put to use. I think that probably also is added.
Okay. And there used to be an underfunded pension liability at, I think, the UK operations. Has that materially, changed anything there? If you can just mention.
Yeah, we have unfunded liabilities rather, in the US and the UK. And they know.
There have been sharp market movements. If there is any number you can just quantify, is that improved or deteriorated?
It will have deteriorated since March because the discount rates have fallen in both areas since March.
Sorry, you were not very audible. Don't mind if you can just repeat again.
Yeah, it will have deteriorated since March because the discount rates have come off about 0.4 to 0.5% since March.
Okay. And just one last question, sir. Earlier, my understanding was that the India soda ash expansion is going to spend some 1,600 crores to expand the, at the Mithapur site. So of that 1,600 crores, how much has been spent so far?
1,600 is not for soda ash. You see, the number we have spoken about Mithapur is split between the salt and soda ash. There is a combined utilities which are there. In terms of capex spend, I think we would have covered about 600 odd crores already on the ground, and balance I think about overall number was 2,400 crores. I think 600 may have gone in, and about 1,800 is still to go. John, you've got more accurate figures.
Yeah, I wouldn't really in too much further than that, but that's reasonable.
Of the 2,400, the balance 1,800 would be spent in the next how many months?
we have that on the
I think it would take about 2.5 years broadly, and could take us right into 22 and 23, somewhere in the middle of May. I think it's very
slide 6 of your presentation that shows you the relative.
It is there on the presentation. Okay, I'll take it. Thank you. I'm done.
Thank you. We take the next question from the line of Ramesh S. from Nirmal Bang. Please go ahead.
Yeah, good morning. Thank you very much. The first question I have is, in terms of the global soda ash industry, do you see any capacity closures that we can see, given that the capacity utilization is already 80%? What is the cash margin you see at which the capacity closure will happen?
I don't think we will see capacity closures except maybe in China and in US, UK, sorry. I think in Europe, these are the two places. In China, I think the way they are dealing with it is they are taking extended maintenance shutdown, and whether they will come back on stream after this extended maintenance shutdown happens is open to interpretation. So one has to constantly keep watching. So I think our assessment is some capacity will go out, but more accurately to see this, we need to watch this, whether they go for completely extended maintenance closure, which runs into 9-12 months or so. Then I think the units will move towards decommissioning completely. As of now, they are taking pretty much a rolling maintenance closure during this period. Zarir, you want to add anything specific beyond this?
No, I think you're right, Mukund. I think there is some risk of capacity closures in China on a permanent basis. Currently, many of those plants have taken extended shutdowns. We've seen in the past in China when somebody takes an extended shutdown of, let's say, more than 12 months, typically that capacity goes offline permanently. That number could be anywhere between 2 to 5 million tons, 5 on the upper end, 2 on the lower end. I think the other thing that's happening certainly is that planned capacity expansions, primarily in North America and China, are likely to be delayed by at least 15 to 24 months.
Okay, and if you look at the current share of the end-use market pie for soda ash, what is the share of the flat glass market globally and in the US?
So, flat glass, I think last year, if you look at the number, it was close to about 32%. Yeah. Given the contraction in the market in 2020, we expect that to probably drop to about 28%.
This is for the US market?
No, this is global.
Okay. Just one last thought. So if you look at the losses in US and UK for the quarter, and supposing assume that this kind of pressure on volumes persists, how are you placed in terms of cash flows to finance your working capital and your capex?
Comfortable. Very comfortable.
So I think as far as we are concerned, we have no issues in terms of financial wherewithal, in terms of first quarter, when you look at it, the losses were actually accentuated at the PAT level by almost 35-40 odd crores, which was one-off. It is not going to repeat itself again. So if you take a PAT figure of about 120 odd crores, we are looking at about 80 crore clawback, which we need to do. I think on a cash profit basis, these units should be fine from the second quarter onwards. It's just that we will make sure our capital spend is in tune with the cash profits which we are earning, especially in US. So we don't anticipate any major issues as far as our ability to service any of our costs are concerned. In fact, as I mentioned, we believe that we could use some of our cash to repay the debt which we have internationally, which we will work and come back to you by second quarter results are done.
Okay, thank you very much.
Thank you. Next question is from the line of Saket Kapoor from Kapoor & Company.
Yes, sir. Good noon, sir, and thank you for the opportunity. Sir, firstly, you spoke about this value addition part in USA, sir. If you could dwell more, what would be the product line for which you are harping on to?
So we are examining 2-3 options there. Let us come back to you, and that will certainly cut back the pressure on volume which is going in the export market. But we will come back to you. I think during the course of the year we will have more details and more color to add. But we have done this in UK, for example. We moved from being a pure soda ash company. Now almost we are saying that we will have a large proportion of the business with bicarbonate. We have done this in India also. We've continued to add bicarb capacity and also adding multiple product lines within Mithapur to make that more robust. So we think there is an opportunity to do a similar job in Magadi and in US, but we'll come back to you specifically during the course. Our teams are working on it. It's essentially our plan. Our plan is not to add substantial volumes in soda ash, but to value in soda ash. That's really the way we are going. And to add volumes in these specialty businesses, because that's where the value creation will happen.
Right. And in terms of UK, sir, is the transition period over, and now the results will start yielding? Because, sir, the EBITDA has moved up from 18 crore to 28 crore, but the PBT and the PAT has remained negative at 15 crore. So if you could explain that.
John, you want to explain that?
Sorry, I missed that question.
Yes, sir. I will.
Yeah, go ahead.
Yes, sir. I was seeking the reply for UK operations, that the transition which we were seeking earlier about energy efficiency and the flue gas experiment patent, is it over and the results have started yielding? And secondly, sir, we find that for this quarter the EBITDA is higher by 10 crore, but the PBT and the PAT are negative to the same tune of 15 crore. So how do you explain this, and what is the trajectory going forward?
So the first part on the carbon capture and use facility rather than energy efficiency facility, we're hoping to get that really in towards the end of this fiscal year, is where we expect to see that starting to produce. So that's that one piece. In the UK, you have a couple other things going on in there. There's also we've got some SPV debt within the UK operations, $75 million, but that's got interest aligned to that. And then we also have about 100 million pounds of bank debt in there. So you do see a big drop off between EBITDA and PBT coming from that. Our target going forward is also, as Mokan said, is to move up the margin chain, which is concentrating more on bicarbonate and soda ash, and use soda ash as the feed for our sales of bicarbonate. Generate more cash and use that then to start satisfying the debt requirements they have in the UK.
So, sir, this EBITDA, this PAT loss and PBT loss was attributed to for what?
There's only two things below EBITDA, and that's it: bank interest and
bank interest and the depreciation part.
Yeah, sure.
Right, sir. And sir, one very small understanding, sir. When we present the segment, there is a bit of confusion, as earlier also speaker has told about this the specialty product part. If we could come with more granular split between, since it has not reached the critical mass, but still said the nutritious science, silica and getting differentiated with the agro one would give a clear picture than being jumbled up in words. So that would give more clarity.
Yeah, we can certainly do that. But the thing to bear in mind here is just now the agro is purely Rallis, and you can see those Rallis results separately. Yeah. So
yes,
standalone specialty is only FOS and silica. But we'll take your points and we'll look at it.
Right, sir. And the very small point about this 38 crores, sir, which you explained about the refinancing cost part. Could you dwell more, and sir, where it is clubbed in the line item?
It's in finance expenses, consolidation.
In the?
Finance expense in consolidation.
Finance expense in consolidation. And what is this translated, this refinancing cost to? What has led to this 38 crore cost?
Yeah, we had a $225 million facility in North America. It was a Term B that was due to mature in August 2020. And December 19, we took out a further $175 million bridge loan, which basically funded the acquisition of the 25% in TCACP from Owens, Illinois. And at the time, we were considering another Term B refinance of $400 million. We're down a certain route to do that. And we're pretty close, but the market, as you can imagine, in March and April was not conducive to a Term B transaction, so we switched away from that into a Term A transaction. And there were a certain amount of cost, fees, legal fees, things like that we wrote off relating to the Term B transaction. That's all.
Thank you. We take the last question from the line of Rohit Nagraj from Sunidhi Securities. Please go ahead.
Yeah, thanks for the opportunity. So in terms of inventories, what is the current situation of soda ash inventories both in Indian market and globally?
Sorry?
Yeah. So our estimate of inventory in India, if you look at what's sitting with producers, is probably about today in the region of 150,000 to 200,000 tons. Global is a tough number for me to give you, but I would estimate that if you take China, Europe, Turkey, North America, and of course the Indian numbers all put together, that could be somewhere in the region maybe of 900,000 to 1 million tons at best. But that's a number that's constantly winding down as producers dial back on production, take extended maintenance shutdowns.
Right. Thanks for that. And last question. In terms of soda ash pricing, are the benefit of all the input costs in terms of, say, raw material or energy costs are currently priced in? And if so, when the capacity utilization is going down, what will be the level at which producers will be able to increase the prices because the fixed cost absorption will be untenable?
So I think as far as soda ash pricing is concerned, it's probably more a function of supply-demand dynamics than it is of cost. And that's really what we are seeing in the marketplace today, in most of the markets where we operate.
All right. So all the input cost benefits are currently being factored in, and incrementally we don't foresee any kind of reduction in input cost as far as the raw materials or energy costs are concerned, right?
I believe that.
All right. Thanks a lot.
Thank you. Well, ladies and gentlemen, that was the last question for today. I would now like to hand the conference back to the management for their closing comments.
Thank you, and thank you, everyone. I think this has been a tough quarter for all our units, and they have performed to the extent the market demand has permitted them to move the material in as aggressively as they could. The good news is some of the demand held up, especially the nutrition as well as the agri products. The softness we saw in the performance material has been primarily driven out of the flat glass demand, which we hope that the markets would begin to stabilize maybe by the fourth quarter of this fiscal year, that is the first quarter of the calendar year next. And this is primarily driven off the softness we have seen in Southeast Asia and in South America. We believe that the Southeast Asian demand would be first one to get off the block, and South America would follow so soon thereafter. Those are the indicative numbers we can give you in terms of the way we see the color of the market. In parallel, I think our strategy is intact. We are going to value add in the performance material, grow the nutrition science, grow the agri science, and wait and watch the situation with our customers in the energy science business. And the company will continue to explore as we move forward, also to look at what we can do with respect to the debt position of the company, especially overseas debt. And we will address these questions as we move forward the coming quarters as we engage with you. Very thankful that all of you have been able to engage with the company, and our employees have been able to stay safe through this period. Thank you all, and look forward to seeing and meeting you the next quarter. We come with more details on the plans forward. Thank you.